Why wouldn't that issue and others, okay, the uncharted territory, the extraordinary measures and everything else, why wouldn't it be a mitigating factor to price earnings multiples? Why would you have an expansion to the rule of 20 and all of that? Why would we go 17, 18? Why wouldn't we stay at 14, 15 or possibly lower?
So the rule of thumb here is that you don't want to fight the Fed. And I would expand that in this environment, that you don't want to fight the central bank. So our central bank, the Federal Reserve, has created roughly a $4 trillion balance sheet amidst the $17 trillion economy. So that's in line with what you're talking about. Mario Draghi ripped a page from Bernanke's book. They were classmates at MIT, so they probably had the same professor in the same class, and he's done the same thing. The BOJ apparently
hung out at the same bars,
they may well have
chased the same girls.
I wasn't there,
okay,
but they may well have. And the BOJ has apparently done something 2 or 3 times the size of what we've done. So you can understand what's going on. Now, to understand what's going on is that the thesis was that the central bank was attempting to lift asset prices, to lift animal spirits and consumer confidence, and hope to get asset prices higher. Now, I don't know per se what these metrics are in Europe or Japan, but here in the United States, real estate prices are up about 13.5% year over year, according to Case-Shiller, and 2/3 of us own our own homes. Equity prices, the S&P 500 over the last year is up 30%, and half of us own stocks in our college funds and retirement funds and whatever. So that has significantly boosted consumer confidence and is starting that transition to this wealth effect, is starting to get GDP getting back to trend line. That is the point in the cycle where the central bank is letting the spotlight get back onto the economy, and then very quietly behind the scenes, they start to let some of their balance sheet roll off or start to slowly sell into the marketplace. So it shouldn't theoretically impact multiples, because they've passed the baton over to another engine, if you will.
Okay.
The economy is starting to go. Inventory restocking is taking place. Consumer spending is picking up. Net exports are improving. They've done what they needed to do in order to stoke the fire somewhere else and allow them to contract their balance sheet.
All right, Rich, thoughts? And Joe?
A couple of things. Number one, this whole notion that the Fed is artificially inflating asset prices, I would remind you that is the whole point of monetary policy. That's what it's all about. The whole thing is to lower the cost of capital so that people take more risk. That's what monetary policy is all about from day one. Yes, they are going to extremes in this cycle because the recession was extreme. But the act of what they are trying to do, there is nothing unusual about their goal and what they're trying to do. So one has to be very careful. The other thing that the surveys show very clearly that bond portfolio managers are historically scared of interest rates rising. ISI, many of you know ISI, puts out a weekly survey, and bond portfolio managers have about, not quite, but almost the shortest durations ever in their portfolios. They are completely wigged out that rates are going up. Hey, we think rates are going up too, okay? But the thing is that they think rates are going up for some horrible reason. The Fed is going to start selling treasuries. The Japanese and Chinese are going to start puking our treasuries. They're going to wake up one day, the dollar is going to be nothing. We're going to be Botswana. I mean, whatever it's going to be, it's this horrible scenario. We think rates are going up for the same reason rates always go up. The economy's getting stronger, right? The trough in the 10-year note was a year and a half ago. It was in July of 2012. The 10-year note troughed at 1.35, 1.4%. It has more than doubled since that point. It hasn't killed the economy, and it hasn't killed the bull market. That's what mid-cycles are all about. The unanticipated improvement in fundamentals outweighs the negative effect of rising rates. That's where we are in the cycle. That's what's going on.